welcome back to Growth Junction, the podcast where we dive deep into the world of Bitcoin finance and crypto by speaking to industry leaders who are shaping the future of the space. I'm Dennis. I've had 2.5 cycles in my bag, so to speak, and I've definitely witnessed the anxiety of the highs and lows in my wallets. Before this, I've worked in marketing for 8 years with multiple agencies, one of them being a top Web3 agency. Today, I have somebody with me who is an expert in risk and stable coins and founder at Cork, Robert Schmitt. Among other things, he was also the winner of a Young Entrepreneur Prize in Sweden and has now founded Cork.tech, which aims to bring stability and risk management to DeFi's pegged asset system. Robert, welcome to the show. Please introduce yourself and tell us a little bit about your background and who's using Cork.
Yeah, good to be here. Thanks for the intro. Yeah, so I mean, my quick background of sort of how I got into Cork and what I did before this was I started off my sort of initial entrepreneurial journey working with AI and satellite data within the sustainability agriculture space. And I built a company there called Vultus over about 5.5 years. And then I left that just before we did an IPO because I didn't really want to be a public company CEO. And then was part of the founding team at Toucan. So Toucan, we launched the first markets to tokenize carbon assets on chain. And we had last cycle, we did around 4 billion of volume on that and had a bit over 100 million TVL, and over 100 projects have built like in our ecosystem. One of them, a notable one, was Klima, which got over $1 billion market cap. And then that sort of whole carbon market imploded, and after that I ended up leaving and went onwards to explore a lot of different like topics and themes. And I'd been designing initially at Toucan, I'd been designing the tokenomics and sort of all the mechanism designs, and we were looking a lot at structured products and mortgage-backed securities, and so I naturally did like a gravitated towards going deeper into that. And ultimately, I ended up doing quite a lot of research into that theme and was going to launch a project there, but then kind of ended up feeling like it was not really the right timing for it. But through that, I started exploring like mortgage risk and credit risk, and this was around the time of like when Blast was sort of the big theme, and there was like the start of this like yield rehypothecation like meta that has over the last, I would say, 1.5 years really become a big trend, specifically with like stable coins being a really big part of that, where we now have really clear stable yields baked into stable coins, and you can like embed those into products and get more and more yield. And so my thesis was, and having experienced this in the past cycle, that if you have a major outflow in the space, you likely will have DPEGs, and those DPEGs can cause sort of cascading liquidations and have, at this point, when you have so much yield rehypothecation, you have systemic implications of that. So for example, last cycle, when Terra Luna collapsed, you had the collapse of Three Arrows Capital. Three Arrows Capital led to basically the collapse of several centralized exchanges because they had been borrowing money to Three Arrows Capital to get yield. You had all this like cascading sort of liquidations and like problems that basically happened from that, and that caused a lot of like volatility and damage to the space. So I wanted to work on something to solve that like general problem, and ended up designing and shaping the protocol Cork, which is basically a market to tokenize risk of, specifically, it could be any type of what we call on-chain credit, but specifically what we refer to in the interim is things like stable coins, liquid staking tokens, restaking tokens, and it allows you to tokenize the risk and trade either side of it. So you can either underwrite someone else's risk and earn a yield by doing that, or you can buy coverage on your risk. So basically, DPEG protection. And this allows you to also trade the risk. So you can, for example, take either side of the trade if you think that the risk is underpriced, overpriced. If you think something is likely to DPEG, you can get a bit of profit by taking that side. And so this this can be used for a variety of different types of actors, but we're ultimately targeting longer term, more like institutional adoption. We think the institutional adoption in the space is here and it's scaling, and it needs adequate risk management to really get to the stage where it needs to get. We think especially large scale institutions will need to have a way to manage the risk. That's what we're hearing from all the institutions we're talking with. And so we see this as a way to accelerate and grow the adoption on chain. That's what we're building.
Right. Awesome. Thanks for that. Why don't you just quickly explain to people who might not know what a PEG and a DPEG is?
Yeah. So ultimately, I think a PEG. So many of the sort of pegged assets, you have an asset that is supposed to track the price of another asset. So if you take, for example, like a simple example will be USDC. It's supposed to track the price of $1, and ultimately, the peg is a story of the two assets because the two assets are not the same. A USDC is not technically the same as just like $1 in a bank account. It's a set of T-bills that are custodied by a set of different custodians, and you have certain types of risks tied to all that, like asset custody and it's like smart contract risk and all these types of things. So you think that the token should always be one-to-one, and it's intended to be that way, and they have usually redemption mechanisms that support the price trading one-to-one. But ultimately, you have a different set of risks for every pegged asset. And so what we think about it is that you have peg deviations naturally because you have changes in these factors, because they're not actually the same token. They're not oftentimes there's many different pegged assets that are trading generally one-to-one to each other, but there's all these things happening that can result in these prices basically moving up or down. And in some cases, tokens look like pegged assets, but they're not actually pegged. They're sort of more like a fund structure, or there's some sort of bond structure. I think the recent DPEG of USDO++, I think, was a great example where it was initially largely communicated as a stablecoin that was supposed to trade that the perfect peg was one-to-one to the dollar, but ultimately the design was a bond, and it was a bond that was for a period not trading with any discount, time discount, and suddenly the market woke up to that, and then it depegged by 10-13%, and then that cost a bunch of liquidations on any market, etc. So I think pegs it's an interesting topic. I think I see, in my opinion, a lot of pegged assets to me have very similar characteristics to credit instruments, because ultimately what you're doing is you're giving someone an asset. Let's say, in the case of USDC, you're giving someone $1 and they're putting that dollar to work in a lot of different ways. So you're basically borrowing them that, and then you're getting a receipt token back, and then they're using that for productive purposes to earn a yield. And to me, that's fundamentally very similar to a credit instrument. And ultimately, I think many of these pegged assets have credit-like risks, and that's why when we talk about this being on-chain credit, we think stable coins, liquid staking tokens, etc., are a form of on-chain credit. And one of many, there's also real assets credit, etc., but basically a form of it.
Yeah. Cool. So your mission is to tokenize DPEG risk. Was there a specific crash, like the Terra crash, that inspired you to go on this mission?
I would say for me, I was luckily not super involved in the Terra Luna collapse. I mean, all my bags were, of course, affected by all the cascading damage from it. But I think in total of my exposure, I think $100 or so to Terra Luna. So it was very minimal.
Okay.
But where I remember very viscerally when the USDC DPEG happened, because at Toucan, basically all our funds we had raised from VCs was in USDC, or like maybe like 90% or so of it. And I remember there was this one weekend where it was depegging, and it was just the price was just going straight down.
Yeah.
It was just really like pure like panic, because it was like,
anxiety.
I mean, we didn't end up selling anything, and so it was all fine in the end. But that really, I would say, fundamentally like shook my confidence in terms of these assets, because I thought USDC could not depeg. I thought it was the safest, most stable token that existed, and then we sort of experienced that. And then after that, I've been in personally involved in a few like smaller tokens that depegged, and oftentimes resulting more in terms of like liquidity mismatches. For example, there was a few tokens on Manta, so like USDM and Stone, where I was sort of stuck there for like a long time in depegged assets, and it was largely due to like a lot of people wanting to exit that ecosystem and there not being an adequate redemption mechanism. And so I think all those experiences combined, I think have, it's shaped my interest in the space. But I would say, like, for me, it's partially that, and then partially, I think, like, I'm very excited about like on-chain finance and wanted to grow. And to me, this seems like a fundamental primitive that's missing, and that's really important to accelerate adoption in the space. So I see it as more a mechanism there to drive that change, whilst of course like my that drove my personal interest in it, having experienced it.
Yeah, cool. So, but you also think that this will make it safer, that people can essentially buy protection against DPEGs?
I think it will partially reduce volatility, because I think you can, in the process of using these assets, especially for with leverage, you can have coverage. That means that you're not as exposed if there's a DPEG, which will result in less sort of cascading liquidations. I think better risk management will improve like the volatility like nature of these things, like when there is like a downside and outflows, if you have adequate risk management, you don't have the same style of crashes that you had, for example, in the past cycle, where you had a lot of just sort of dominoes that just keep falling one after another, because one thing collapses, that leads to another thing collapses, etc. So I think this is a way to make the systemic risk like have less teeth in terms of causing all this cascading problems. And I think another mechanism which is really important is the ability to price risk. So I think currently you don't have any real way to understand what the different risk profiles of all these different assets is. And I think the best way to have an understanding of that is to create risk pricing in the market, so that the market can see and internalize what the price is of holding different tokens, what the price is of different sources of yield. And so I think that's another mechanism that I think will help inform the market and make it more effective. But yeah, ultimately, we're not going to eliminate the risk of DPEGs. Like, the risk is still going to be there, but I think we might shield some participants from the damage, and more importantly, just give people a choice. It's a choice of, do you want to take on the full risk? Do you want to take on partial risk, or do you want to take on like no risk? And I think that's like a choice that I think is important, in particular to like institutional actors, to be able to have this be acceptable within their like risk management frameworks.
Yeah, cool, awesome. So and people are also able to earn some stable coins or yield on the Cork vault. Please explain a little bit about that.
Yeah, so I would say from a high level, it's you can earn a yield by taking on someone else's like DPEG risk, and so this is a new form of organic yield in the space. And so it's a new primitive, it's a new use case, so it also creates a new like form of yield. Specifically, we have a vault mechanism we've designed in our system, which is called the liquidity vault, which enables you to both underwrite the risk, but you also earn fees from the protocol. There's certain mechanisms that have fees in the protocol that all flow through the liquidity vault, and you also earn trading fees. So this is like you're earning a fee from all those different sources. So that's currently our design, and so we think also as a new form of yield, I think that's going to be interesting and have its own kind of use case, because it's a yield is its own primitive, and I think that can get integrated in various places too.
Yeah, awesome. So this crypto cycle is like torn between the AI driven speculation and the push for stability, really. How are you how are you focused on the pricing DPEG risk? How does it fit into this tug of war, so to speak? And where do you see it taking DeFi in the future, in 5 years, for example?
Yeah, I see it partially as a bit of a sort of clash between the sort of meme coin sort of trend type investment and the fundamentals type investment, where I would say we sit very much in the camp of we think DeFi is creating fundamental value for finance. I think it's the future of credit markets, it's the future of financial markets. And if you look at just the fundamentals of what's happening on chain with the adoption of stable coins, real world assets coming on chain, and all this regulatory winds shifting, I think we're a part of that whole theme. And I believe over time, markets are the famous Warren Buffett quote: markets are a weighing machine over time. In the short term, it's a voting machine. So I think in the past we've seen a lot of attention to meme coins and speculation. I think it's it's a useful form of gambling. I have nothing inherently against it. It can be fun, participate in it, etc. But I think what I'm really here to build is the future of finance, and I think we do that by building new primitives, improving the existing primitives, and onboarding larger sources of capital onto the space. And so that's what I'm excited about. And I think ultimately that's where the future is headed. I think that's when we look at where crypto is today, the vast majority of the market cap is Bitcoin. And the reason why Bitcoin has such a large market cap is because it's getting this large scale institutional adoption. It's getting worldwide adoption by governments, institutions, private individuals, whales, etc. I think DeFi is in this still sort of it's not in the infancy, it's definitely matured beyond that, but many pockets of DeFi, especially things like credit flowing on chain and real world assets, we're talking about, we're talking about tens of billions of dollars there, when the credit markets are it's $100+ trillion. Just a single issuance of mortgage-backed securities is generally several $billion, for example.
Yeah.
And once these things start happening on chain, I think we can very quickly have this growing in orders of magnitude. I think it's just been a function of regulatory challenges where the large institutions have not been able to easily touch these asset classes. They haven't been allowed to. It's been too risky. It's been difficult to custody, all these things. And I think all those barriers are very rapidly eroding. And I think we're starting to really see this flow happening. And so I would not be surprised if we see really explosive growth in terms of these assets coming on chain, and these assets therefore being the foundation of yield in DeFi. I think that's going to grow DeFi tremendously. And I think DeFi is there to exist. In my opinion, DeFi has historically mostly served the sort of on-chain economy. It's been meme coins, liquid staking tokens, NFTs, etc. There's all these different flows that are happening in the space that are very on-chain native. Now we're starting to see the real world coming on chain, and I think DeFi is going to be embedded in that, and I think that's going to result in just the next leg of growth for DeFi.
Yeah, awesome. You basically answered my next question, which would have been how you see the landscape at the moment, and if it's making it easier or harder for you to operate. Anything to add on that, or?
Yeah, I think I would say in particular, there's different, on the regulatory side, there's of course a lot of different geographies that, the picture's a little bit different, but I'd say the general theme, especially with sort of new administration in the US, is I would say it's becoming less risky. I think you have much less risk of enforcement action. So I think that in itself is, I would say, opening up some doors. But we still are quite early in this process. I would say the regulatory clarity is not here yet. I would expect it to take at least another year before we have real regulatory clarity. In the meantime, again, I think all the changes have been largely quite positive. I think in general, just the global acceptance. I think this what's happening in the US is also being reflected towards the rest of the world. I think when you see the US making all these very positive announcements about this, it's becoming more and more commonly accepted worldwide that this actually potentially is the future of finance, and we should not stifle this growth. We need to adopt it, embrace it, and support it. And so I think the space is generally becoming more and more positive. I cannot been in crypto for around 6 years or so, but I cannot remember a single time when it was even remotely close to how positive the things are as they are right now. And maybe not asset prices, but in terms of at least the fundamental adoption and the view of where it's going and the growth and potential, I am very excited about it. And I think we're in a really good spot. I think the next year or two, I think are going to be very exciting for DeFi, and look forward to helping hopefully be part of it.
Yeah, for sure. It's very exciting what's happening there in the States, and for crypto especially. I mean, we had El Salvador, now USA is the biggest economy in the world is hopping onto the wagon also. I mean, yeah, like the dominoes, it will, one after one will join instead of collapse, I guess. So yeah, that's what I'm hoping for also. But tell me, what does your day look like? What does the founder of Cork do on a daily basis for the company?
Yeah, I mean, I think my days they vary quite a lot. I personally, I always every day, spend a little bit of time outside, walking, and a bit of time exercising. That's part of the standard. But beyond that, it changes a lot. For me, I personally currently I'm working a lot on the next version of the protocol, understanding a little bit more. We just launched a few weeks ago, and understanding a little bit the adoption we have currently, and designing the tweaks and changes to improve capital efficiency for the next version. In general, I'd say where we are right now and what we're focused a lot on now is growing adoption. So it's both getting new use cases and improving new use cases with the protocol, getting integrations done, and beyond that, improving capital efficiency of the system. But yeah, I mean, my general day is it's probably half the day is meetings, and then the other half the day is deep work, and then a bit of personal time in nature. That's
yeah. Cool. Sounds like you have some balance there. What if you had a magic wand, and if you could solve the one problem in for Cork, or what would it be?
Well, I think I would say probably currently I would say the capital efficiency of the system is something which, I mean, that's something which I'm really focused on right now for the next version, which is I think we can make the way we tokenize and underwrite risk much more capital efficient than it currently is. And I think that's going to significantly increase the markets that will economically make sense for this tick system. And I think significantly increase the adoption of this derivative. So I'd say that to me is one of the if I could wave a magic wand, I would have that already be fixed. But I think that's something we're currently working on. Probably over the next 6 months or so, we'll make a really good progress.
Yeah. What kind of partners do you have so far?
Our launch partners were Dina, Etherfi, Lido, and Spark. So those are kind of core ones we've been on so far. Like ultimately, we're talking to like most of the major like lending protocols and asset issuers in the space. We're I can't announce them yet, but we have a lot of really interesting things coming up. I think in general, like one use case which I'm very excited about that we'll soon demonstrate is protected looping trades. So where you can create a looping trade similar to, like, let's say on the lending market, you're depositing a yield bearing, let's say stablecoin, take Athena, and then you're borrowing, let's say USDC, you're selling the USDC to buy more Athena, and then you keep looping that to get more and more yield. So that whole design, we think, using hedging in that can create a much more sustainable like design that is basically liquidation risk free, where you can lever this up without having, like, currently you're oftentimes doing these hard coded oracles that create various types of systemic risks in terms of bad debt also for participants. So yeah, we think we can do a much better looping trade using hedging, and that's something which, yeah, I'm very excited about proving that out with some lending market partners. But yeah, in general, I would say we're fortunate enough to have very good relations with quite a lot of the key DeFi builders, and are excited about showcasing some of those integrations that come up soon.
Awesome. So if I've understood it correctly, I could use the protocol to both buy risk and sell risk, right?
Yeah, exactly. So you can take, like, on the one side of the trade, you're basically earning a fixed yield. So for example, currently on like if we take one of our markets, which is Tether. So Tether currently you can earn a fixed yield of around 7% by underwriting Tether, but that's a fixed part of the yield, and then you're also earning this variable yield, which is the Athena yield, because it's like Athena Tether. So in total, you're earning like roughly like 11% or so, and if Athena yield goes up, then it would be more than 11%. So that's by underwriting the risk. So you're taking on the risk of Athena plus Tether. So if either of those DPEG, you will basically end up with a DPEG asset. On the other side, you can then take the bet against Tether. So there's like a whole ecosystem of people who think Tether is going to DPEG, and so they can buy the other side. And if Tether would DPEG, they would have a very significant upside. You have very high leverage in this trade. So let's say each, what we call the DPEG swaps, which is the swap token that allows you to bet against a DPEG or to hedge.
Yeah.
So with this token, let's say it's trading at like half a cent, you're basically getting like 200x like leverage, because you're buying like 200 tokens for $1. So if Tether would then DPEG by, let's say, 10%, you suddenly then end up with like a 20x upside on your bet. So that's kind of how the market also makes sense from that perspective. The market can also, like, in a sense, it's not necessarily that someone has to lose here. It can also be a market balancing mechanism where you have a lot of these temporary DPEGs, and people who have the swap token can make a profit also when there's a temporary DPEG. So if it DPEGs by, like, let's say there's a big outflow, there's certain tokens that DPEG like constantly, like 1-2%. You're buying it for like half a cent, it DPEGs by 2%, so it goes to 2 cents. So you made like a 300% like increase there, and then you can perform a redemption and then kind of return it back. So it's this, like, all these other ways you can also use it as like a load balancing mechanism and make profit from arbitrage. So that's another use case.
All right. Sounds a bit complicated, but to somebody who's not into programming and stuff like that. But I've done a lot of DeFi before, and it's quite easy to use the platforms and get your head around it once doing it, for sure. So yeah, I thank you. That was really, really insightful, and thank you to Robert for sharing his expertise. And yeah, it was a pleasure talking to you. Do you have any last words, or please tell people where and how they can find you, and yeah, how they can get in touch?
Yeah, I mean, I think the easiest way is you can, like on Twitter or X, you can find me at RobDogETH. And in terms of Cork, it's Cork Protocol on X as well, and you can try our new primitive on app.cork.tech if you're interested in using
Yeah, awesome. So thanks again, Robert. If you enjoyed this episode, leave a like and subscribe and share if you want. And yeah, thank you for tuning in. And until next time, stay curious and keep building. See you next time. Bye for now.